$380 billion. That is how much cash Warren Buffett is sitting on right now. That's the largest in his entire history. But why? Look, I'm not going to tease you with the answer. I'll tell you and then you can decide if you want to stick around for another 10 minutes to hear my thoughts on it and how it changes my portfolio. So this weekend, Buffett's successor Greg Abel walked onto stage in Omaha and said a few words that should scare you if you're unprepared, but you're going to be prepared. He told Berkshire Hathaway shareholders that the company is waiting for, quote, dislocations in markets that are going to allow him to act. So what does this mean? It means that they are preparing for a crash while CNBC is telling you to buy the dip. My name's Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, this is not financial advice. This is not an inducement to buy or sell any assets. Investing is high risk, and most importantly, do not take financial advice from some random dude on YouTube. All right, so today I'm going to break down why Buffett is ready for a crash and how he's positioning, how the banks are secretly doing the same, and most importantly, what this means for us and how we prepare. Let's figure this out together. So we're going to start with Warren Buffett's history. Buffett's whole career has basically been him sitting on his hands and waiting for the world to break. On Saturday in Omaha, he said in 60 years of running Berkshire Hathaway, he's had maybe 5 juicy years, 5 out of 60. I mean, that's not him being humble. That's him telling you flat out how he actually invests, how he thinks about investing, because he's the king of patience. He waits for the world to break, then he buys more than anybody else can afford to because everyone else has been spending their money. Take 2008. Lehman Brothers went down, then Goldman started going down. The whole investment banking system was about to collapse. So Buffett picks up the phone and in the next couple of days, Berkshire wires Goldman $5 billion in exchange for preferred shares paying 10% plus warrants on common stock. Basically, he asked for a massive discount and because they were desperate, they had to give it to him. That single deal made Berkshire about $3 billion in clean profit. $3 billion. That's why Warren Buffett is a legend. And the only reason he could even pick up the phone was because he'd been sitting on a pile of cash that everyone said he should have deployed. Everyone, by the way. Analysts, the financial press, his own shareholders, they all thought he'd absolutely lost it. They thought he was getting rusty, but that's his playbook. The cash isn't idle. The cash is loaded and waiting for the markets to crash. Same playbook that he used in the dot-com years, by the way. He refused to buy a single internet stock while everyone else was making millions on pets.com. By the time that NASDAQ had lost almost 85% of its value, Berkshire was still standing while everyone else was in the rubble. And the same playbook that he used in COVID, same playbook that he's using right now. So when we hear that he's now sitting on a record $380 billion in cash, the question isn't, wow, why is Warren Buffett being so cautious? The question is, why is everyone else still buying? Why is everyone else being so stupid? But let's walk through the numbers because I'm a data guy and I like the numbers, right? So Berkshire announced that they now hold $380 billion in cash and short-term treasury bills. That's up $7 billion from the end of last year. But the most interesting part is that the Berkshire cash pile has gone up 6-fold over the last decade. So in Q1 alone, Berkshire sold $24 billion of stock. They only bought back around $15.9 billion. So they booked $7.2 billion in taxable gains on those sales. That is the largest disposal quarter since 2024, when they dumped a chunk of, I think it was Apple at the time. And here's the part that CNBC won't tell you because they don't want you to know this. Berkshire's net income more than doubled this quarter to $10.1 billion. So they're making a lot of money. Operating earnings across all of their subsidiaries were up like 18% on the year. The business is healthy, but he's selling stocks anyway. But what is he selling? That's the big question. Well, the answer is simple. He's selling banking, financial services, and consumer products. Stop and think about that combo for a second because it's very interesting. He's dumping the businesses that lend to the consumer, the businesses that broker their trades, and the businesses that sell them stuff. Buffett is short consumers, which should come as no surprise since consumer sentiment is at record lows right now. Lows it hasn't seen since 2008. And we're going to talk about that later because consumers are the backbone of the economy. And when consumers stop spending, when consumers are scared, the economy often collapses very soon after. I mean, when I say often, almost every single time. So Buffett has had a complete loss of faith in the American consumer and the financial network that feeds them, allegedly. So I'm going to talk more about how this impacts my portfolio later, but let's talk about Greg Abel. For those who don't know, he's the new CEO of Berkshire Hathaway after Buffett retired. This weekend was his first big public statement. He could have said literally anything he wanted, but what does he say? And I'm going to translate it for you. We're going to go back and forth between me and Greg. So he says the big cash pile they're sitting on right now means that Berkshire is not beholden to anyone.
We do not intend to be beholden to anyone. We start with that position.
Translation, we owe nobody. We can sit on this for as long as we like. Then he says,
we're not anxious to just deploy capital into subpar opportunities.
Translation, everything looks subpar to me right now. I don't want to buy everything because everything's overpriced. Everything looks like crap. We'll talk more about that in a second. And then the killer line.
There will be dislocations in markets that, again, will allow us to act.
Dislocations, plural. Dislocations is the kind of word that Wall Street uses for the type of break where pension funds get margin calls and forced sellers hand assets to whoever still has cash, just like 2008 when Buffett bought up a bunch of Goldman stock, right? So he's not saying that markets might dump a little. He's saying that the music is about to stop and he has enough cash to buy the blood. And by the way, just because they're sitting on cash, this doesn't mean you should sell everything. I'm going to break this down when I break down the rules to my portfolio in a bit. But it's important to understand that you are not a billionaire. I'm not a billionaire. So we have to think about the markets differently. But still, we need to think about why they're doing this and how we should position. So we'll talk about that later. By the way, quick interruption for today's sponsor, me. My newsletter, it's free. Sign up to it. There's a link below. Every morning I share my thoughts on the market. It allows you to keep up to date with what's going on in finance. No reason not to sign up. Link below. It's free. I'll see you in there. Now, look, the markets are in a weird place right now. The message is buy, buy, buy. Strategists are coming back on TV, returning to optimism in AI. That's what they're saying, stuff like that. Translation, buy AI, buy Mag 7. Don't look at the numbers, switch off your brain and buy. Don't ask questions, click the green button. That's what they're telling you. But the reality is that the Mag 7 moves are retail driven. Big players are positioning for a crash. The Bank of America's most defensive portfolio, the boring dividend paying, sleep at night stuff, is having its best year since 1933. I'm laughing because 1933 was the Great Depression, by the way. I think it was the bottom of the Great Depression. So the professionals who actually allocate the real money are quietly buying the boring stuff that you only buy when you think the world is fragile. And then they tell you to buy the Mag 7 because they need someone to sell it to, right? They hold that, they need to sell it, so they're selling it to retail, allegedly. Okay, so let's talk about what Buffett is selling and why. First thing is they're dumping US stocks, right? Why? Because of valuations. SPX printed fresh all-time highs last week, so did NDX, and I think even this morning they're printing highs again. Buffett's been saying for years that US stock valuations are silly, and Abel has just inherited that view, Greg Abel. So when you'd rather hold T-bills than buy stocks at these prices, what you're telling shareholders, the message you're giving them is that a short-term treasury right now pays you 4% for just waiting. If you can't find a stock that you think is going to reliably beat that, the rational move is the 4%. That's what they're telling shareholders. And that's exactly what they're doing. And it's not just Buffett, by the way. Wall Street banks hold more treasuries now than they have since 2007. Net treasury inventories held by these elite firms have surged to an average of $550 billion this year. This basically means that Buffett, banks, hedge funds, they're all selling while retail buys. Why though? Well, there's actually a number named after Buffett for exactly this scenario. It's called the Buffett Indicator. He calls it the single greatest measure of stock valuations. How does it work? It's quite simple. You take the total value of the US stock market and you divide it by the size of the entire US economy. So how big is the stock market compared to the country that it sits in, right? Historically, the average is around 100%. Anything over 130 is overvalued. Anything over 200%, in his own words, is playing with fire. And right now it's sitting at 230%. That's above dot-com bubble highs, by the way. If the indicator that has your name on it is sitting at record highs, what do? You sit on cash, right? Because everything is overvalued, which is exactly what Buffett is doing. The second thing Buffett is doing is dumping banks right now. Remember how I said in 2008, Buffett waited for Goldman to crash, then he bought their shares cheap? Well, he's selling bank shares right now. I wonder if he plans to buy them back cheap. Why though? Why is he selling banks? That's a question we have to ask, right? Because it's not enough to just say he's selling. We have to think about why he's selling. So banks are sitting on commercial real estate that nobody wants right now. So that's one thing. They have a lot of exposure to commercial real estate. They're also exposed to private credit funds that have started gating up withdrawals. I've talked about this before. This is very bad. And they are lending to a consumer who is leaning on credit cards just to go buy groceries. That's an absolutely fragile flaw. And look, I'm not going to go on about banks, but there's a reason Buffett is getting out, right? But the third and the most important factor in Buffett's decision making is the macro setup. Consumer sentiment is at all-time lows in the US, and I've talked about this, but let's go into it a little bit further. People in the US are feeling worse about their financial situation right now than they did during the 2008 financial crisis. That is crazy to think about. Like, picture this, the worst financial crisis in modern history, people feel worse now than they did during that. My editor said to me, oh, you know, consumer sentiment fell below 50. 50 is Mordor. Right? And 50 is Mordor. If you're a Lord of the Rings fan, you'll get that. If not, then ignore me. Anyway, did you know that pawn shops, by the way, I heard this the other day, pawn shops are seeing a massive influx of middle and even upper middle class people pawning items to pay their bills. That should tell you where the economy is right now. Because when you tie all this together, the picture is bleak. Buffett is cashing up, selling banks and shorting consumers, which brings us to portfolios. What portfolios perform the best in bleak market conditions? Because SPX and NASDAQ are all at all-time highs. So you'd be forgiven for thinking that the Mag 7 is the best place to be right now, and SPX and NDX and all that kind of stuff. But like I said earlier, the Bank of America's Sleep Like a Baby portfolio is having its best year since 1933. This portfolio is essentially what the smart money is doing, what I've been talking about for months. And the structure is simple, 4 buckets, equal weight, 25% each. Now, you don't have to follow this exactly. It's just a template, right? 25% in stocks. This is simple indexes like SPX and NDX. So you do have some stock exposure, right? 25% in bonds, 25% in cash, and 25% in commodities like gold and silver. Look, I'm about 35% in commodities, but you know, that's what I said. It's a template. It's not something that you have to follow exactly. So there's no clever overlay, no fancy quant modeling. And this year, that boring 4-way split has returned around 26%. Best year for it since 1933. Better than most of the AI crap retail is going all in on. That's up a little bit, is at all-time highs, but it's up nowhere near as much, right? You don't have to copy this portfolio exactly like I said, but you should look at it and discuss it with your financial advisor, right? So now let's talk about my playbook for the next year. 5 rules, all practical, all built on what Buffett does, which is how I've built my entire investing career. Rule 1 is no leverage, no exceptions. Look, I always start with this rule because it's the one that saves you, and using leverage is what absolutely destroys you, right? Leverage is how people lose everything. So the reason Buffett could write that check to Goldman Sachs in 2008 was because he had no debt to service, none. And actually, by the way, the amount of leverage in the markets is often a sign that a crash is coming. And leverage is now at record highs, 1.2 trillion. That is how much fake money is propping up this market, which is why Buffett said this. I'm putting this quote up on screen, read it and think about it, right? And the translation of that is people are buying with borrowed money, so everything is way too expensive right now. That's why I don't use leverage, and that's why my portfolio is mostly boring stuff and not AI stocks right now. I sold my AI stocks at the end of 2025 and I don't regret it. Rule number 2, match the smart money's posture, not their exact trades. Look, we don't all have $380 billion to deploy. I mean, we don't. I wish I did, but I don't, right? And you probably don't. But we can match the shape of what Buffett is doing. The shape is high cash, low equity, very selective on quality. So you don't need to be 95% in T-bills. But the question worth asking yourself is, am I closer to Greg Abel, Warren Buffett, or am I closer to the Robin Hood degen buying call options on Palantir, right? There is a spectrum, and you should probably aim to be closer to the Buffett and Abel side of that spectrum than to the degenerate leverage gambler side of that spectrum. Which brings me to rule 3, be boring. Consumer staples, utilities, energy, big, dull, profitable companies that sell stuff people buy in a recession. And yes, I know Berkshire just sold some consumer products, but that was it was very specific. It was a couple of names where the brand power has slipped. So, you know, you still have to think about what you're buying, right? The category itself is still strong and it pays good dividends and it still works in a downturn because boring wins in a downturn. I've been saying this for a while, and the market is proving me right recently, by the way. Nobody really talks about it because Nvidia is making all-time highs, so that's newsworthy. Everyone's like, oh my God, look at Nvidia. But like I said, boring portfolios are outperforming Nvidia anyway. Not over the last 3 years, but right now, right? So if anything, boring is more exciting right now if you know where to look and if you know how to think about it. Anyway, rule 4, hold something that they can't print. I talk about this all the time. Look, cash is fine for ammunition, but cash isn't fine forever. The dollar dropped 9% in 2025. That's the worst year for the dollar since 2017. And they're openly running a weak dollar policy. I mean, that's what Trump wants. He's stating that he wants a weak dollar, right? So you want a bucket of stuff they can't physically print. Treasuries can be printed. The dollar can be debased. The stock market can be inflated by liquidity sloshing that sloshes back into it, right? But you can't mint a ton of gold or 1 million ounces of silver out of thin air. It's a physical asset. And I know you technically there are paper versions of gold and silver, and that is a big problem. But still, the reality is the gold and silver you hold is a real asset. And the point is all balance, right? Some cash for the dislocation, some metals for the debasement, some boring productive assets for the income in between. Rule 5, you don't need to do anything drastic today. Guys, look, this is the most important rule, and it's the one that nobody on YouTube wants to tell you. You have time. Crashes don't arrive on Tuesday at 3 p.m. in the afternoon. They unfold over months. And I think the US dollar is dying. I think debasement's only going to get worse. But that doesn't mean I'm selling everything, buying dollars, and making any drastic actions today. It doesn't mean I'm buying a bunch of seeds so I can sow my own fields and make my own crops in a depression, right? Buffett's been building his cash pile for 14 straight quarters. He is not panicking. You shouldn't either. Be patient. I'll see you in the next one.